Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have John Langston, founder and managing partner of Republic Capital Group, to discuss M&A trends in the RIA space. John, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill. Glad to be here.
Tell us about Republic Capital Group.
We provide investment banking services to the wealth and asset management community. Founded the firm 8 years ago. Over the last 4 years or so, we've been involved in about 40 transactions. We are fortunate to be a leader in that space. And it's a very active time, but it's our specialty to focus there in the RIA and wealth management space.
It certainly is a popular time for this. I mean,
yeah.
We talk about it a lot on Trade Talks. What's your current outlook on the M&A space in the wealth management business?
You know, it's interesting. There's been a lot of discussion about there being a slowdown at the end of last year, and immediately following some of those predictions, we saw a record week. So I would say that our outlook continues to be that it will be strong. The biggest headwinds, I think, really have been more about perception that the market is changing. The reality we're experiencing on the ground in actual transactions is that quality firms are still commanding very strong multiples. There are adjustments in how things are structured and that sort of thing, but honestly, I worry about the perception that people feel as if, well, valuations are going down, I'll wait. That's not what we're seeing, but there's no question that we're seeing some dynamics that are impacting the amount of activity in the space.
What are some of the trends that you're seeing?
It's really the best time, as I look back over the last 7 or 8 years, for a firm that is, let's say, $3 to $15 billion in assets to compete on acquisitions. We've come through a period where it was so competitive that it was very difficult to win those processes. But what's happened is the largest acquirers are telling us now that they have their largest pipelines ever of opportunities. So they become much more selective. So I think there will be a number of firms that get passed over by the large acquirers, and firms who decide not to pursue those relationships, who will be very open to a regional or a smaller firm that, again, is in this $3 to $15 billion space. So I feel like we're going to see a surge of activity with those type firms. And frankly, I think that will be good for the industry because we'll have, you know, additional stronger regional firms that can be an alternative to maybe going with a national player.
Right. What are some of the bigger mistakes that you see with buyers and sellers during the M&A process, and how are you advising them?
Yeah, it's a great question. The first thing I would say is that, you know, given our space is very relationship driven. You know, a big part of the foundation is this idea that we're fiduciaries, we have relationships with our clients. And so a lot of potential transactions that are not going through a formal professional process spend a lot of time on the relationship side, the vision side, a lot of terminology around cultural fit. But in reality, what's happening is no one is really, in a methodical way, developing a shared understanding of what each party's expectations are. One of the things that a professional investment banking process does is it helps that occur along with the relationship. And simplistically speaking, one of these would be valuation, right? I often hear stories of firms who have engaged with one another for 12 to 18 months, only to suddenly realize that they are just miles apart on valuation. And so I think that's a big mistake. The second thing I would say is having not understanding that a firm can have a similar mission or culture to you, but look and feel differently. Don't go looking for your twin in the marketplace. Mm-hmm. You often need other skills and abilities to broaden your firm. So I would say that. And then I would say those two things are probably the bigger keys for mistakes.
What could a firm do to increase their valuation?
Yeah, I think there's a couple of ways to think about you know, how a firm can achieve the highest value. There's really two approaches that we see. Either a firm is structured in such a way that the firm can generate clients, potential business for advisors that they can afford to support a base of employee advisors. And what that means, obviously, is that you have more resources to work with in terms of the cash flow. So you either structure your firm in such a way that you can attract advisors and make them employees and pay them a salary plus bonus. And there's some great firms doing this, and there are advisors in those firms who are earning great compensation because the firm is growing and is so successful. So that can absolutely work. The other perspective is that the advisors are equity holders in the business. What happens there is because they're equity holders, they're tied to the business. Outside investors have a lot more confidence about them staying with the firm. And so those two approaches are the most powerful way. Where you don't want to be is in the middle, where your advisors are not employees and they're not equity holders, which means, of course, they're free agents essentially to go and do other things. And so those firms that we think of as generally terminology would be platform firms really have the least amount of value in the marketplace. But there's really, frankly, I think one of the best opportunities in the industry for those firms to either move to a model that equitizes the advisors or to move to an employee-based model.
All right. Appreciate the insight, John. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.